In today's video, we're going to be answering a question that a subscriber asked on my last video, Piotrowski F-score method, which was based on a study by Joseph D. Piotrowski in January of 2002. In the first part of the video, we're going to look at Piotrowski's original research paper and his original findings. Then we're going to break down Piotrowski's 9-part formula. Then we're going to backtest that using Portfolio 123. First of all, shout out to Portfolio 123. My man Marco hooked me up with a free researcher subscription. I was paying for it myself. This is the best tool, bar none, for retail investors to backtest different strategies, run screeners, track your portfolio. So if you're interested, be sure to check that out. I'll put a link in the description down below. And then after we backtest the original F-score, I'm going to see if we can make some improvements to the score, and then we're going to backtest my modified Piotrowski F-score. Maybe I should rename this to like the Winkleplex F-score. I'm not sure who has the coolest and most memorable name, me or Joseph Piotrowski, but I'll probably give him a run for his money, but we'll call it whatever we want. We'll talk about that at the very end of the video. So what Piotrowski found was that he could use a simple accounting-based fundamental analysis strategy ranked from 0 to 9, and we'll talk more about that in just a minute, but he applied that to a portfolio of high book-to-market firms. So he looked at data between 1976 and 1999, and he found that he could increase the returns by at least 7.5% annually compared with just standard value investment portfolios. And if you would create a strategy that would buy expected winners and short expected losers, that would generate a 23% annual return. Piotrowski used 9 simple financial ratios, and each one of those ratios simply had a binary yes or no. So if it passed the criteria, it got a score of 1 point, and if it did not, it got 0 for that particular ratio. So the maximum score that you can get is 9, the minimum is 0. And he broke those scores into 3 different categories. The first category was profitability. He first simply had positive return on assets. This essentially equates to positive net income, since net income is the numerator. So if they have positive net income, positive return on assets, that would get 1 point. If not, they get 0 points. The second is having positive cash flow from operations over the last 12 months. Next, he had a positive return on assets over the last 12 months. So this would be return on assets increasing from any level. As long as they increase, even if they increase from 1% to 2%, that would count as a positive score. And the last was based on the Sloan ratio, which is that the cash flow from operations should be higher than net income. This essentially reflects your earnings coming from legitimate cash flows and not just a bunch of accruals. The next category was what he called financial leverage / liquidity. The first was an increase in long-term debt as a percentage of the assets. So taking on more debt relative to your assets, not a good thing in Piotrowski's score system. The next was an increase in current ratio. That received 1 point. And current ratio is simply defined as the current assets divided by the current liabilities. If that ratio was increasing, then you got a point. If not, you got 0. The third was 0% or lower increase in your share count. If a business is increasing its share count, that means it's diluting current shareholders and essentially is unable to fund its existing operations without most likely issuing debt and issuing new shares. So if you had 0% increase in shares over the last 12 months, those would all get 1 point. And the third category was operating efficiency. The first was higher gross margins. So if your gross margins, which is revenue minus cost of goods sold divided by sales, if that increased over the last 12 months, then you get 1 point. And then finally, an improvement in asset turnover. And this is defined as sales divided by assets. So if a company is able to generate more sales with the same amount of assets or generate the same amount of sales with less assets, that would be 1 point. If not, it's 0. And Piotrowski's backtest of his formula was nothing short of astounding. He started with the universe of the entire CompuStat universe, and then he selected the top 20% book to market stocks. So these would be low price to book ratio is another way to think of this. So the 20% cheapest stocks by that metric. And then within that universe, he selected even further to select either the stocks with 8 or 9 on his scoring system compared with those who scored 0 or 1. So buying stocks that had a high either 8 or 9 score and scored in the top 20th percentile on high book to market generated an average return of 23.9%. If you adjust that for how the market did, it was 5.9% per year better. If you bought and held for 2 years, those stocks generated raw total returns of 47.9 or 12.7% better than the market. This is how all firms did, broken down by their different F scores. So you can see the worst stocks on the F score, getting a 0, returned an average of negative 6.1 over the next 1 year. Those that scored 1 got a negative 10.2%, etc., etc. But the point is that you see a very clear increase in average returns as you go up the list. So the stocks that scored 6 or greater, that seemed to be the break point to where you got 11% to 15.9% annual returns, whereas the stocks that scored a 5 or lower, probably below bond returns, and in some cases even negative returns once you got into scores of 3 or worse. Petrosky published this paper in 2002, which was more than 20 years ago. So what would happen if we updated this study for today? Does this ratio still work? To find out, I built my own backtest in Portfolio 123, and I did it in 3 different methods. The first, I replicated exactly what Petrosky did in his study. So I chose the bottom 66% in market cap, so looking at only small and mid-cap type companies. Then I sorted by the top 20% book to market, eliminating the 80% highest book to market stocks, only leaving the cheapest 20%. And then I only took the stocks that scored at least 8 or 9 on the Petrosky F-score formula. So this was the original Petrosky formula as best as I could replicate it. And you can see that this screen, which is represented by the red line, dramatically underperformed the S&P 500, which is here. Just to confirm, these are total return numbers, including dividends reinvested. So you can see it generated less than half the total return, worked out to annualized underperformance of about 3.5% per year. It also had a much bigger maximum drawdown of 69%, terrible risk-adjusted Sharpe and Sortino ratios, much higher standard deviation. Clearly, this did not perform nearly as well as Petrosky found in his time period. So what if we just looked at the top 20% book-to-market stocks and scores 8 and 9? The scores improved by about 0.5% per year, but still you can see that the max drawdown and the risk-adjusted ratios are not close to the S&P 500, still producing compound total returns of about half of what the market did with even more risk. But what would happen if we eliminated the market cap and the value requirement and only looked at the pure Petrosky F-score? That's what I did in the third backtest. So here I'm only looking at those that scored 8 and 9 across the entire market segment, big, small, and medium-sized companies, and including all stocks booked to market, not just the top 20%. Surprisingly, that increased returns dramatically. So you went from underperforming the market to outperforming the market slightly, generating about 1.2% higher annual returns. Maximum drawdowns were reduced. And then the Sharpe and Sortino ratios were both right on par with the S&P 500. But is there a way to modify the Petrosky F-score formula to make it more applicable to buying higher quality companies? In his research paper, Petrosky talks about debt. Debt is not always a bad thing, he talks about. In fact, in some cases, it can be a good thing. However, for the basket of stocks that Petrosky is looking at, he's looking at more distressed, value, low liquidity stocks. So for them, higher debt is a bad thing. So for our purposes here, if we're looking more for higher quality companies, we can eliminate this leverage and replace it with 2 other factors. In my new and improved Petrosky F-score formula, I took away the increase in long-term debt relative to assets, and I replaced that with a 1-year change in return on equity. And then instead of using a higher current ratio, I replaced that with companies with higher retained earnings today on their balance sheet than they had 5 years ago. So these two metrics were added to the equation and these two were removed. The results of this screen were significantly better than the S&P 500 on total returns, generating 13.5% annually compared with 10.8% of the same time period for the S&P. We also had significantly lower maximum drawdown, which means our risk-adjusted ratios, particularly my favorite being the Sortino, is significantly higher than the S&P, suggesting positive risk-adjusted performance. So replacing the leverage metrics and adding in return on equity and higher retained earnings seems to improve the formula, at least as it pertains to the more recent period, the last 20 years, instead of the 20-year period that Petrosky was studying. Now, will the next 20 years be anything like this most recent 20-year period? Maybe, and maybe not. Maybe Petrosky's formula will work better in the next 20 than this one shows today. But Petrosky says in his research paper, and I think this is really the main takeaway from his research, and that is using a simple formula, simple binary 0 or 1 for different fundamental variables, can be an excellent way to help you screen stocks. And if you're interested in digging in beyond the scope of this video, I'm going to post the spreadsheet that has all the stocks that currently score an 8 or a 9 on the Petrosky F-score modified version that I made here that this screen reflects. I'll post that spreadsheet over on my Patreon page, and I'll post it to YouTube members. The focus of this channel is to educate, not entertain, to provide data, not opinions, and to do so with humility and not hype. So if you're interested in more investment-specific content like this, be sure to hit the subscribe button and check out the links in the description below.